Welcome to Deal Dialogue.
Hello and welcome to Deal Dialogue, a discussion on all things related to M&A and financing. I'm Rob Hickey with RBC Mid-Market M&A. In the ongoing theme of innovation and enhancements to transactions to make them more efficient and de-risk them, today we're going to discuss a key component of any transaction: due diligence reporting and quality of earnings reports. Now, these topics have been around for a while, but the market has changed and we are seeing some innovation. So with Tarek and myself today are some special guests from RSM, Ben Gibbons and Brian Atkinson. Gentlemen, welcome to the podcast.
Thank you, Rob.
Thank you.
Before we delve into the details, can you provide us some background on yourselves and RSM, as well as your business there?
Will do. So my name's Ben Gibbons. I'm a partner here at RSM. I head up the transaction services group across Canada. From a background perspective, I've been involved in investment banking and transaction services for about 12 years, originally in Australia and more recently in Canada.
My name is Brian Atkinson. I'm a director in our transaction advisory services practice. I lead our financial due diligence practice for both Toronto and Detroit. I've been focused on financial due diligence for about 15 years and do both buy side and sell side.
So RSM, just to provide a bit of an overview, RSM is an integrated practice across Canada and the US. We have about 11,000 people across the markets in about 95 offices. Our focus is purely on the middle market. We are North America's leading professional services firm focused on the middle market. Our transaction services practice is about 450 individuals covering financial diligence, M&A tax, and then some operational diligence items like cyber and IT.
Great. When a deal gets to a certain size and complexity, the deal principals are going to rely on advisors for various aspects of the transaction. One area is due diligence, which can encompass many areas. The findings are typically found in due diligence reports. I'm not talking about legal here. And these reports are sometimes known, at least one of them, as a quality of earnings report. But I think I'm just sort of scratching the surface of what due diligence is. Perhaps you can enlighten us on how you view the due diligence component of a transaction and all the different pieces.
Yeah, look, RSM's approach to due diligence is what we call a holistic approach. So we focus ultimately on two areas. One is risk mitigants and two is value drivers. We think for any transaction, de-risking the deal and then ultimately identifying where the key value drivers are ultimately the key to a successful transaction. So to your question, Rob, the areas that we focus on in a diligence, certainly start off typically on financial areas, and as you suggested, the quality of those earnings and making sure the EBITDA is the EBITDA that everyone expects in a transaction, and kind of de-risking that throughout the transaction process and ensuring that you as an advisor, but also ultimately your clients are getting the right numbers are certainly key to getting to the back end and a successful result. But further to that, areas like tax, IT and some of the operational items are becoming certainly much more prevalent in the market, and areas where certainly buyers and their advisors are certainly focused on a lot more in detail as well.
And on the financial side, I would say it's even more than just the adjusted EBITDA. We spend a fair amount of time focusing on working capital and also identifying debt-like items that could potentially impact the purchase price and making sure we fully understand those and can articulate those.
When do you typically get involved with a company that's either contemplating or in a transaction?
I would say on the buy side, it varies. Sometimes we'll get involved if it's an auction process. Prior to an LOI, we can provide a little bit of high-level insight into the numbers so they can submit the best possible offer. But oftentimes it's after they've submitted the LOI and they're in exclusivity. Is when we'll get heavily involved on the buy side. On the sell side, it's upfront in the process. Typically it's the same time as the bankers are getting engaged, and we're kind of running a parallel process with the bankers, and we're focused on the numbers as the bankers are trying to pull their materials together to go take the company to the market.
And I think we would always advocate earlier the better. there's no too early to have the conversation, either with your advisor or certainly with someone such as ourselves related to the diligence, and just getting in front of some of those issues, starting to talk about those issues, and getting prepared for the transaction. Our continued point on transactions is preparation leads to a successful result. So the earlier you can get into that preparation phase, the better, and the more likely you are to de-risk a transaction.
A buyer is obviously going to talk to you when they're looking at a deal. Want to shift the focus a little bit, talked a little bit about innovation at the front end. One of the things we're certainly seeing is the growth of the use of sell-side Q of E. Can you talk a little bit about why a company should consider doing sell-side Q of E and how it can help them realize their objectives in a transaction?
Yeah, at a high level, I spoke a little earlier about kind of two things: mitigating risk and maximizing value. And certainly, as an advisor, that's obviously what you're focusing on and working with your client. But as a diligence provider, that's certainly where we focus our efforts. And we talk about de-risking a transaction in a number of fronts. One is obviously getting to the right numbers and ensuring that we're all on the same page with the numbers that are obviously driving the valuation discussion, and with the buyer and the seller. But also, those other items that I mentioned, getting in front of IT and cyber and some of the operational diligence items, tax, etc., to ensure you're de-risking that transaction, getting in front of those issues at the front end and mitigating them, creates a more efficient process, allows the buyer, when they're doing their diligence, to be more efficient in their process. But I think ultimately where the true value comes in is helping the advisor, such as yourself, in obviously identifying how to really kind of sell the story and sell and position the company for the right outcome, whether it's valuation driven or whether it's some other items that are obviously important to the seller as they're contemplating their succession plan. It's getting to the right result that allows them to really tell the right story and create the efficient and successful result.
Yeah, and I think part of that, is in the sell-side diligence, you're going to identify issues, and we can help position for the client, so that when the buyers are coming in and doing their diligence, we're already out ahead of the issues, have a response already crafted and thought through, and I think that helps minimize the opportunity for retrading down the road. I mean, that's certainly one thing that we all want to avoid is buyers getting in and finding something, and then all of a sudden their valuation changes meaningfully, and that makes for a difficult conversation later down the road.
How long does it typically take to do a sell-side diligence?
I would say 5 weeks is probably your starting point, and it's probably plus minus a week or two on average. Is what a typical engagement would take.
In your experience, at what point in the process does a buyer see your report on the sell side?
On the sell side, it's interesting. It will vary, but typically it's probably once the buyer pool has been narrowed down to some extent. So not everybody who gets a teaser, they may not. They likely won't see our report. It's probably once it's narrowed down to 5, 10 potential buyers, and at that point, not only do they get to see our report, but oftentimes we'll also have a call with the buyers and or their advisors to go through our report, so they can address any questions they may have and kind of help them get more educated on the numbers and our report.
And in your experience, how effective is that report in terms of de-risking for the client? I mean, obviously the buyer is going to do whatever diligence they're going to do, but can you give an example of how a report helped to make a process more efficient?
Yes, perfect example. I had a client, $15 million revenue business, never been audited, QuickBooks, founder-owned, didn't have an accounting team. So really, without a sell-side due diligence report, the buyers would have, they wouldn't have known what they were getting themselves into from a numbers perspective. So we went in there, obtained their QuickBooks backup file, and really did a thorough scrubbing the numbers to not only identify what the adjusted EBITDA was, but we're also we're able to use the actual numbers themselves to help tell the story. And in this situation, it was a company that sold products online, both through their website as well as Amazon, and we were able to support the story that all the revenue growth was coming from sales through their proprietary website, which had a much higher contribution margin than the Amazon sales, and that was one of the keys to the story and the thesis for the sale.
You talked a little bit earlier about a holistic approach to the diligence. Can you touch on a few areas over and above Q of E and working capital, if you're given a fairly broad scope, that you would touch on in a sell-side diligence or in a buy-side diligence for that matter?
Yeah, I think the kind of first obvious area is tax. Certainly getting in front of the tax issues that may or may not exist, and ensuring that obviously a company is compliant, and to the extent that they're not, making sure that they kind of get compliant quickly throughout the transaction process before close. Obviously, that may delay a closing process. So to the extent that we're on the sell side and getting in front of those early is certainly key. I think the two other areas that we're seeing kind of most common now, IT diligence is certainly the most prevalent kind of third area or third bucket of our holistic diligence approach. Spending a lot of time with our clients across Canada and the US on those issues that are certainly prevalent in this middle market. Sometimes the investment in IT systems has kind of fallen down as they've focused on I guess the more operational parts of their business, and obviously cyber diligence is becoming significantly more prevalent. I think the market itself has kind of shifted a lot over the last couple of years. We're seeing a lot more activity from a cyber attack perspective, companies being held for ransom. Just getting in front of those issues, ensuring the policies and processes the company has is obviously becoming much more prevalent.
In your experience, whether you're on the buy side or on the sell side, what are one or two things you just seem to find more and more when you're doing these diligence approaches in terms of something that's glaring that just wasn't done and you found it as a result of your work?
I would say a lot of times, especially in the smaller middle market, it's just the accounting is not up to par, and so a lot of times they hadn't accrued for certain items or were recording things incorrectly, and digging through the information and speaking with the management team, identifying those issues, and then not only identifying them, help quantifying what what the numbers should have been during the period. I would say we see that pretty often.
Okay. Shifting a little bit to the buy side, who is commissioning you to do quality of earnings reports and diligence? Who are the buyers of your services? I'm overusing the word buyer, but
I think certainly private equity firms. We have a big practice servicing private equity in this middle market. There's a lot of capital, as you know, that's in the market looking for good quality deal flow. And as we continue to talk to clients around succession planning, private equity is very prevalent in the market. They are big buyers of diligence services and consulting services generally. So they are certainly big buyers of our services on the buy side, and therefore certainly big proponents of that. Therefore on the sell side. Whether they're engaging us or whether they're expecting a sell-side report when they're kind of looking at a transaction process. In the kind of corporate and strategic market, it's still a big part of our practice as well. We spend a lot of time with corporate buyers, as they think about and de-risking their transaction process. And the way we approach a private equity buyer versus a corporate or strategic buyer is different. We tailor our approach. They obviously have different outcomes that they're focusing on, long-term, synergies, those kind of things that we spend a little bit more time with corporate buyers than potentially some private equity buyers who we know are obviously looking at their investment and a hold period and how to exit a company and get the right transaction structure for that process.
Yeah. And from the corporate side of things, we're who we're probably dealing with is it's oftentimes going to be the CFO and the CEO, and then depending on the size of the organization, there could be a corporate development person as well.
So I guess the message is, if you're a seller of a company, the buyer, if it's a substantial transaction, whether it's private equity or a corporate, they're likely going to engage somebody to do quality of earnings work. So it's going to come up in the transaction somewhere.
Correct.
Okay. How do you typically cost out these assignments, whether it's on the sell side or the buy side?
I mean, it's typically we're on a time and materials basis, but we will provide a fee range, and we generally try to stay within that range unless there's unforeseen circumstances that we just couldn't have known on the upfront. And to do that, we estimate, based on our experience, how much time we think it's going to take to complete the project, and base our estimate on that.
And then, our approach is obviously working with either the advisor or, obviously the client itself on kind of what the meaningful items as well are that we need to focus on based on their expertise. But I think, we've obviously, we do about 700 odd deals a year across RSM. So we have a lot of experience, obviously, doing diligence work. So one of the things that we're obviously looking to be is an advisor to the process as well. There's certain things that you and or your client may think are important from a scope perspective, but we know that certain issues are going to come up, and you want to get ahead of them. So we want to work with you to kind of refine a scope that really works for the transaction and getting back to that result that works.
Yeah, and oftentimes we'll also stage our work and phase it so that we're focusing on key potential risk areas and making sure we're comfortable with that before launching a full-blown diligence process and getting tax and IT involved. Let's make sure there's an actual deal to be made before going down that path.
You've both been doing this. I mean, obviously people can't see you. I can see you. You don't look as old as me, but you've both been doing this for a while, judging by your level of experience and knowledge. In the last few years, are you seeing any changes or trends in the market that you're focused on?
Yeah, outside of the probably more holistic approach, IT and cyber becoming much more prevalent. I think the other area that we're seeing a lot of activity on is in the data analytics side. Mm-hmm. The tools and software that certainly we have access to and utilize as a diligent provider, be it on the sell side or buy side, is allowing us to get a lot more insights into the history, but also the trends that therefore we can kind of talk to the growth opportunities for either a buyer or seller as we're going through this process. So we're certainly seeing a lot more information, data sets that we can really kind of drive a lot more meaningful information out of.
Yeah, and I'd say the other trend too is we're just the prevalence of sell side due diligence. When I first started this, sell side was pretty rare and probably limited to the carve-out situations and very unique situations. And over the course of my career and probably the last 3 to 5 years, it's really flipped, and we're seeing sell side on most of the transactions that's being run by a banker and has a process. So that's definitely a shift in the market that we've seen play out in the last several years.
You talked earlier about starting early. So if I'm an advisor to a company, whether I'm a lawyer or a banker, an accountant, how do I get the client thinking about this early? What are the things that I should be asking them to think about and the value?
I would say one thing. I mean, especially if they've not been audited, is have they taken a thorough look at their results? Are there areas that could potentially, if it's a year out, 18 months out, that they could be focused on during that next 12 to 18 months to help improve earnings and make sure not only improve it for the short term, but to make sure that the improvements are sustainable. So it's really just seeing if they've done that thorough assessment at that point, and if not, that might be a good opportunity to bring in someone like ourselves to advise them on areas that they could be focused on.
And then I think just talking to value, I kind of just think about the metric, $5 million EBITDA business, going to sell for 6 times as an example. It's a $30 million transaction. So to the extent any kind of plus or minus on the EBITDA, call it $1 million plus or minus, it becomes a $5 million adjustment to purchase price up or down. So the value to our services becomes very apparent very quickly. And last time I checked, we're not charging $5 million for a diligence report. So the return on investment is pretty significant.
Well, that's a pretty powerful way to end this segment. So that's it for this segment of Deal Dialogue. Our guests today were Ben Gibbons and Brian Atkinson. Thanks for being here.
Thanks for having us.
I'm Rob Hickey, and our production engineer is Tarek Chami. Have a great day and good luck with your deals. Deal Dialogue is a production of RBC Mid-Market M&A.